you guys want to go ahead and introduce yourself?
Yeah. Good morning. My name is Kellow Kuehl, CIBM Mortgage. Been a residential mortgage lender for about 5 years. Really love it. We are based out of Brookfield and Elm Grove. That is where our bank offices are, both on Blue Mountain Road. I personally work remotely, live in West Bend, carrying the family torch. So I'm a second generation mortgage lender, and my mom Beth and my stepdad Rick here have been in the business their whole lives as well. So trying to learn from the best and keep it going. So
thanks. I'm Rick Kellow. We've been doing this, Beth and I, she cringes when I say this, we're approaching 80 years combined in the business. So there's not a lot we haven't seen. We started on stone tablets. Closing for yes, and closings were 3 signatures. Everything was carbon paper, and those were the types of things. And a lot of those techniques have still followed through as far as old school lending. Justin will give you the insight as far as the credit score and give you a little bit of an education. That's what we can do, and then I'll fill in some gaps on the networking and how we help build your business in the process. We have some interesting techniques to share with you today, in addition to keeping your business, building your business, and showing what we do, what our skill sets are. If anybody understands who CIBM Bank is, you win an award. It's the Central Illinois Bank Marine. It's easier just to remember that way. We fund all of our own loans. We do all of our own loans. We're able to write our pre-approvals over the weekend for you if you need to. We are a direct underwrite. We are Fannie and Freddie. We are VA, but it's just a tease to some of the stuff that we do. We can work some amazing things out, and we're going to show you some of the things that we can do that other lenders may have told you in the past, saying, oh, we can't do that. And that's an easy way of doing it. And sometimes it's, if not now, when? And how soon can we do this? And how we can keep some of these deals together for you. We'll help close your loans, but we'll also help build your business.
thank you. So credit for me is a little personal success story. Got out of college, made some less than favorable decisions, had some work to do with some debts and things like that. So I did get out of school, probably had about a 580 credit score. 12 to 13 months later, after a little bit of work, I was sitting in the 750 range. Bought a house shortly, 2 years after that with my mortgage experience. For me, credit is just an algorithm that wants to dictate our lives and our customers' lives. But we're going to try and figure out, how to best handle these, what the sources of credit, and some tips that I can share with you guys, because I do look at credit report after credit report every day. So 3 main credit reporting agencies, Equifax, Experian, TransUnion, they all collect and maintain consumer credit information, then resell it to other businesses in the form of a credit report. We do pay for credit reports. They are a charge. And those charges are actually increasing. Average credit report today for a lender is close to $100. They are the 3 largest publicly traded for-profit companies. So it is not a non-for-profit, they are a business. They are also regulated by the Fair Credit Reporting Act. So anything, errors, things that weren't reported correctly, your creditor didn't report it correctly, you have those rights to fight that information. So it is always a good idea to get a current copy of your report, review those things, especially with people with like-minded names. There are a lot of errors that we'll find on the credit report. Not their loan, wasn't an inquiry, things that weren't done right, when you have last name Smith, Johnson, things like that. So, and feel free, if you guys have any questions, I love to kind of just open this up into a general conversation. So feel free. Credit reports, lenders contract with Equifax, Experian, and TransUnion to receive these reports when they apply for loans, credit cards, mortgages, or in-store credit. Credit report shows a consumer's current and past credit as reported by banks, credit cards, mortgage companies, any creditor that has your information. And if they do report, certain industries or certain banks do not report to the credit bureaus. Report will show things like outstanding balances, what the different trade lines are, whether it's an installment loan, an auto loan, a mortgage, a HELOC, a revolving card, all the different mixes of credit that are out there. Also show you your payment terms. If you have a 6-year auto loan, it's got 72 months of payments, how many payments are left, what's being reported, what the current balance is. We'll also show any past due histories as well as collections and bankruptcies. Generally, when it comes to past dues, they are looked at between 30 and 60 days, 60 to 90 and 120 plus. So if you do have it late on the report, you really want it to be the 30 to 60. Once you start getting into that 60, 90, 120 days plus, it really starts to affect your score. Credit reports do contain errors like we talked about, so very important to review those things. Soft pulls for consumers. There is annualcreditreport.com. You are allowed one free credit report that you can get yourself. My FICO is a cost to the consumer, but it's another good site. And my personal favorite is honestly Credit Karma. I know Credit Sesame, I've heard, has some pretty good things too, but I personally use Credit Karma and always have. It's a baseline tool. It's not going to give you an exact number, but if you're trying to build your credit, you're trying to see how things are progressing, it's a great tool. It has no hit to your credit. You put in your information, your social, it'll bring up all your accounts. It will also give you suggestions as to what could improve these scores. So, you know, when somebody says, hey, I have a 740, I said, where did you find that? Well, I have a Credit Karma, I have a Capital One thing. Okay. Generally, when it comes to mortgage scores, whatever that Credit Karma, Capital One, what I call consumer score, the mortgage scores can be a little bit different. Generally, 10 to 20 points less than what I see on the consumer score. So if somebody tells me, you know, my Credit Karma is showing a 760, most of the time, if I pull that report, it'll come in a 750 or a 740. Just because it is a consumer score, like if you went for a soft pull for an auto loan, generally those scores are quite a bit higher when it comes to our hard pulls with mortgages.
Is that just because there's less data on a soft pull than a hard pull?
Correct.
And the Credit Karma is free, right?
Yes, and Credit Karma is free. Heard good things about Credit Sesame as well, just never used them personally.
What about the ones that are, like, I feel like every one of my bank accounts, all
Yeah,
of it,
they're all very same kind of types of things. Credit Karma was kind of one of the first ones, and then you see it with your credit cards. I think even US Bank has an app. So they're all kind of a basic educated consumer score. But if somebody's, hey, I want to buy a house in 2 years, I want to see how my stuff is going, progressing, they are good tools because you don't have a pull that's going on your report. Most widely used credit scores are considered FICO scores, so Fair Isaac Corporation. FICO scores range differently between each bureau, but are very similar. They all have very similar scoring models, but they are slightly different. So as you can see here, you know, Experian would be the highest possible score out of anything. They go up to an 844, TransUnion will go to an 839, and Equifax will go to an 818.
So even though the little thing goes all the way to 900, you could never get there. So just
I've never seen an 840.
okay.
So that's, you know, that's absolutely perfect in
Yeah.
all of their algorithms and everything else.
Yeah.
So in this world, to be getting to something that is 750 and above is an A+ score, because they change the algorithm and then they make things a little tougher. And so somebody who's at that high 700s, that's ideal. Somebody who gets to the 800, they're up there. Yeah.
Yeah, and she hit it right on the head. I mean, you know, kind of prime pricing, you know, a few years back used to be 740 and above. Now we're seeing they're taking that another tier to 760. Generally a 740 to a 759 is one set of pricing. 760 to a, you know, 779, one set of pricing. It's all usually in 20-point blocks. So every 20 points really makes a difference. Or if we pull a score and it comes in at a 735, is there a possibility we can do a rapid rescore or something like that, send it back to the credit bureau to get into that 740 range, improve the pricing for the borrower, as well as credit scores are the main factor in private mortgage insurance. So many people are very afraid of private mortgage insurance in today's world. Like if you have a 750 or higher, you put down 5 or 10%. Generally, every private mortgage insurance I'm doing with those scores is under $100 a month. A lot of them $40, $50, $60 a month. So versus putting another 25,000 down at 10%, you know, 250 purchase or 30, that's a lot of money you would have to save and a lot more time.
I tell my
younger buyers, like first time buyers that all the time. They're like, well, we have 20, we want to put 20% down. And I say, just ask what your PMI would be at 10%, what it would be at 15%, and then make that educated decision, because I'd rather pay $99 on a 10% down than to give up all my cash that I have sitting.
Correct. Yep, and when they're buying a house too, you know, all the expenses that come with moving and the transitions and, you know, just having a safety net too, you know, we do not want to see these borrowers and these buyers using all these funds, a little bit of safety net, a little bit of comfortability when they get home, things like that. But yeah, especially conventional loans, credit score is the number one determining factor besides down payment for your private mortgage insurance. So comes to an FHA, it's a little bit different. It's a set standard rate. The rate will dictate a little bit due to the credit score with the private mortgage insurance. It's gonna stay the same rate. So each lender has their own strategy, including the level of risk it finds acceptable for a given product. Your score will not only determine your ability to get credit, but the interest rate, programs available, and other terms. Kind of my favorite part here, how a FICO is calculated. Number one factor, payment history. Make those payments on time, especially with today's world and the technological world we're in. Auto pay, suggested to everyone. Get it done, whether it's even the minimum payment, we just need to make that payment. We don't want to see it late. Set up the auto pay, even if it's the minimum. If you want to make an additional payment, put more down on that balance, that's great. But we need to make sure that payment is coming in a timely fashion. Number two is going to be your amounts owed. So your total amount of debt, as well as another factor of this, is the amount of credit you are using compared to your credit lines. The number one thing I can tell you is I have so many conversations with customers that pay my credit card off every month. How could it be affecting my score? Well, you have a $5,000 credit limit. You're putting $4,000 on that card every month. Even though you're paying it off every month, the credit bureau is waving a red flag saying, what if you don't pay that off next month? You're using 80% of that credit line. I'll get into it a little bit in the next slide or the next couple slides, but ideally 15% or less. If you have a $10,000 card, you don't want to put more than $1,500 on that. Very small credit limits if you want to maximize. 20 to 25%, yeah, you'll probably still have a pretty good score, but anytime you start getting 40, 50, 60, 70% of that credit line, your score's gonna drop.
So I always make a joke to people that like I'm the worst credit card person ever because I charge everything. Like, do people use that term anymore? Charge, like charge card?
Yep.
I just came out of my head and it sounded funny, but I charge everything and then I pay it off, right? The months that I don't have a commission check, I might ride it a little bit. Boy, just my credit score will bounce it up. And I have a ton of, like I have 3 major credit cards. Amazon, of course.
Yep.
And Costco, of course, and then Capital One, and you get % back on everything. So I use it for everything and then I pay it off. And I can see my credit score go up on the months that I don't pay it off. And I think that that's some trickery. Because these are big high limits, right? So I'm not charging, like excessive. But boy, they love it when you pay their finance fees and you get rewarded with higher credit scores.
Yeah.
That's not cool. It is not cool. I think Capital One does it worse than anybody, to be honest with you. But I just wanted to say that, in my opinion.
Are you watching it by Credit Karma? What are you watching?
I watch it on all 3 of my credit cards. And they're vastly different because they all use different reporting agencies.
So you're saying your score goes up when you
When you carry a balance.
when you carry a balance.
On my Capital One card. Everything's set to pay off automatically on the other 2 cards. But Capital One's the one that I might keep a balance on if I'm not getting paid a commission that month. And it's the one that's the one that'll go sky high.
Gotcha, and it really kind of depends on too, like who the creditor is, so I think you might be right with Capital One. Because sometimes too, people say, I pay that off every month, and I'm like, I have balances for every credit card you have. So is it it's paid off monthly, but depending on when they report that, they're gonna report that balance back to the agency, you know what I mean? So
Yeah,
they'll do it on a monthly, but sometimes, depending on when they report it, they might report the balance after the payment was made. Cause I see it all the time. People will say, hey, I pay it off every month. Every month is paid off in statements. I pulled the report. It shows $1,200 on a $4,000 card.
it just angers me to pay finance fees, so that's why I paid off. every
Oh,
month.
for sure.
It angers me. But my son, who's in the army, and I wanted to help him, both of my kids are tied to my Capital One with their social security numbers, so they both have my credit score off my Capital One, because they ride on there. And I'm going to tell you, I get a call from him. Mom, why is my credit score down? Why does, what are you doing? Why don't you pay this bill? And I'm like, I do not need another parent. Like,
Otherwise, it's good just to understand it too. And I mean, until you're gonna apply for credit, you know,
Mhm.
start figuring that into, you know.
Well, I don't want them to apply for credit.
A
That's
few
why I give them
months
my credit.
before, but I've also seen too, when you pull these reports, it'll say, you know, Equifax, Experian, TransUnion, you generally give me 4 to 5 lines of the positives and the negatives of what's going on with those. And sometimes you will see it says account has never carried a balance.
Wow,
So I've done it myself too, where I seen it on mine, it said the account has never carried a balance, never carried a balance. So what did I do? I paid it off down to $1. That would be my suggestion for you. Carry a $1 balance.
interesting.
That would be my
You can
suggestion.
afford the interest on $1.
There is nothing that angers me more than paying finance, but I throw out more in produce a month than what the finance charges are. But, right, I mean, I buy, I want those cuties, well, they're gone. And dead, I didn't eat them, but it angers me to pay that.
Yeah, so I get, like I said, sometimes it's how they operate, but we just kind of gotta know. Other biggest one is gonna be your length of credit history, how long you've had those accounts established. Personal, you know, story here, I do have one small student loan, I've had it, it's my oldest credit line. I still haven't paid it off. Monthly payment, I mean, my rate is in the mid 4% range, but it's only a few $1,000s, but it's my oldest credit line. I don't wanna see that end. If that credit line gets paid off, you think your score would go up? It's gonna go down. Because you do not have that history reporting for it anymore. Your oldest credit card, your oldest credit lines, keep those open as long as you can and keep them going. Do not just keep it open and not use it, because that's not gonna benefit you either. Or if you do have cards that, you know, you want them to report towards your score, but you don't wanna, I don't want it in my wallet, I don't want this. I have one personally, it's set up to pay my, you know, $50 phone bill every month. The card's in my safe. I know exactly what that bill's gonna be. It's reporting, that's my oldest credit card. Does that make sense? The last two would be your new credits, so all the, you know, new accounts you have on there, as well as your credit mix. So do you have installments, revolving, mortgages, you know, equity loans? What's your matrix of all those different credit look like? So, yeah, payment history, number one, 35%. Talked about the 30, 60, 90-day dues. Late mortgage payments are a killer. That is the worst thing you can get on your credit score, on your credit report. Also, you know, is gonna be a big thing if they're looking to buy a house in the next, you know, 12 months or so. You know, really depends on what program they're gonna go, if we can get that pushed through. But generally on a, you know, a conventional loan, we're looking for at least 12 months of consistent mortgage payments, no rates within the last 12 months. FHA, we can probably get it done. But in terms of today's market, you know, correct me if I'm wrong, but conventional is king right now. Amounts owed, 30% difference between the available credit and the current balance. There's the point that I wanted to point out, that the balance of 15% of under of the available credit line is best. 1% is better than 0, kind of going back to that roll over $1 on the balance for it. Length of credit history, 15%, don't close the cards, credit mix, revolving installment, mortgage, new credit and credit inquiries.
How did HELOCs fit into that?
It's a revolving, so it's a revolving account, but it generally reports as a mortgage.
It does, okay.
Correct. But you will see it's a revolving. mortgage, basically, is what it looks like.
But if you have a $25,000 HELOC amount, but even if you don't have a balance, that shows up as accessible credit.
Correct,
Okay,
correct, yep. So if you've never used it, it's out there. So debt to income ratio is what lenders refer to as DTI. Along with your credit scores, your DTI is going to be another critical component. The lender considers in extending credit. Generally, your DTI is calculated by dividing your gross monthly income by your total monthly debts. So, a DTI of about 45% is usually considered the upper limit of what we can lend on as lenders. And that encompasses all of your monthly payments. So if your gross monthly income for your family is $10,000, generally speaking, about $4,500 a month in gross payments for everything you guys have out there is what we can lend on. If it is just the home, I have no debt, but I want to buy as much house as I can, usually 40 to 41% is what you're looking for. So you can have a few extra percent for the other things, your credit cards, your auto, this and that, but if you just wanted, the only debt I have is my house, usually 40 to 41% is the cutoff. This I just priced out yesterday. So these are accurate numbers for some purchases, just to give you an idea of how that credit score really changes. So on the left-hand side, we have a conventional 30-year fixed, 350 purchase, 5% down. Kind of your standard, cookie cutter loan for today. If we do it with the 740, we're coming in right at about 7.5%. The principal and interest on that is going to be $2,325. That private mortgage insurance is pricing at $99. Total monthly payment $24.24. If we drop down to a 700 FICO, our rate is going to go up to 7.875. It's going to bring that payment up to $2,411. And it's going to bring our private mortgage insurance up to $155 a month. See how the private mortgage insurance is jumping along with the rate. If we get down to a 660, our rate's going to be in that low 8% range, about 8 and 8. Principal and interest will go up almost, around $150 compared to that 740 FICO. Now we're looking at $2,469. Now our private mortgage insurance is really starting to go up there. We're looking at about $295. If we go down to the minimum qualification of a 620 on a conventional loan, you're looking at about 8.375 on the rate, about $350 a month on the private mortgage insurance. So difference between a 740 and a 620, just in terms of monthly payment, you're over $400 could be the difference in the swing, just because of credit score and private mortgage insurance.
And that's because risk. It's evaluated based on risk, and the lower the score, the higher the risk, which means the lower the score, there's been some type of history or negativity that was there in the past, and it's all based on risk. So if that borrower who does take that kind of rate and interest rates come down, even at the end of 12 or 24 months, if rates still stay at that level, we want to refinance them, because with that new mortgage and a pay history, that credit score should be escalating. And then we can get that mortgage insurance down. Property value probably went up, credit score went up, then we want to refinance them and improve their payment history and reduce the mortgage insurance and possibly reduce their rate at the same time.
Yeah, and with today's appreciation in the market, a lot of times if we do come, and we're gonna look at a refinance in a year or two, they might have came in with 5% at the start. They might not have even done anything to the property, just the appreciation and paying off a little bit of the balance. We might rewrite that loan in 12 to 24 months at a 85. Now their private mortgage insurance went from 95% loan to value to 85, from $125 to $46 plus the savings in the rate. So when it comes to refinancing, there's more than just the savings in the rate. If the LTV is dropping or reducing, there can also be a substantial savings in that private mortgage insurance. So looking at an FHA, credit score is not too much of a factor. Like we discussed, FHA in today's market is a little bit of a challenge. Those sellers are looking for that conventional loan or those cash offers to win these deals. So as FHA, a little bit harder to get done in today's market, but I just wanted to show you, compared to the credit score, the interest rate changes a bit. I mean, we're starting at, 6.75 at the 740. If we go down to a 620, we're at 7.75. But the big factor I'm trying to point out here is that private mortgage insurance stays the same. But, the difference between the FHA and the conventional is that 1.75% financed FHA MIP rate that gets added into a loan. So that's how they try and combat the private mortgage insurance rates and keep them reasonable for the consumer. Any questions on
I'm sorry,
that?
what was the premium you just mentioned?
So the funding fee, the FHA MIP funding fee, 1.75% of the loan amount.
Yep, okay. I just
It's added
missed that.
in.
Thanks, yeah.
You do VA loans as well.
We do VA.
Oh, yeah.
What,
Yeah, we just finished a loan in South Carolina, 100% financing for $1 million.
what, how does, I guess in comparison to like a FHA? I guess I always feel like those are clumped together, but they're really kind of shouldn't be, right? Because VA loan is guaranteed.
Yep.
Right?
So the VA loan is guaranteed. There's no private mortgage insurance on your VA loan. Depending on, the borrower's status, they may or may not have to pay a funding fee, depending on how they were discharged from the military. So sometimes when
If
they
they have
come
a
out,
disability over 10%, I think, no, over 50%, no.
No, it's almost any amount.
Yeah, so if they have a disability, they probably will get out of PMI, but the funding fee is 3 times that what FHA is. That's how they get away with it too, is that that's how it's guaranteed, is the funding fee is 3, and on the first one, it's like 3, what?
yeah, 2.1.
0.15.
No, that's for the subsequent ones, the first one is higher.
No, you have it just the opposite.
Oh.
They reuse it, their reuse fee is 3.4.
Okay, okay,
If they refinance, it's very low.
okay,
But the VA has no private mortgage insurance on the payment for any loan, even up to
Okay.
100%, they don't have any. But they do have the upfront funding premium, and that's what allows them to guarantee the loan. That's a type of insurance, that funding fee that they do.
so LRA just offered just 2 days ago, the military relocation thing, which was basically done by Bill Meisel, another lender, so that's all he does. So I learned stuff in there, and I've been doing VA loans for 20 years, and I learned stuff in there that I had no clue about. Really shocking. And it's probably, most agents don't understand even how to present it to your sellers. So if that comes up again as a class, I give a big plug for going through it.
Yeah.
Plus he bought lunch, so much like you guys. So 2 lunches this week. Very job, folks.
VA loans are great loans for that borrower, and it's tough to stay in the market that's, oh, this is a VA, seller won't even look at it. But the VA does everything possible to get that borrower into that property.
Are there
And
some pretty competitive things you can do with it that I didn't know that? you
on the
could?
sales side,
Mhm.
yep, that's good. That's good, because those individuals need to be in houses.
I have an active military son, so I'm,
Yeah.
yes,
Yep,
I would say that.
yep.
What do they need it, like, I'm sorry, that's.
No, go ahead.
Sorry for the meeting. Do they just need like what a DD 214 in order to prove, is that,
The COI, certificate of eligibility, or sorry, COE.
Yeah, they need to go to their local VA office and apply to get their certificate of eligibility. So as a lender, we approve them based on what they qualify financially, and the VA approves them based on their service, that they qualify for this loan based on service. So sometimes the veteran is a little bit of miscommunication that I've got my VA certificate, so now I'm already qualified for a loan. No, you're qualified to be eligible for the loan based on your service. Now you qualify based on your income and your credit and those types of things. But yeah, the DD 214 and a couple other documents, they get to their VA officer and they can get their eligibility certificate. So when they come to us, we need to know that they have their eligibility certificate, or at least have applied for it, because the process is going to go very quickly. If they don't have that certificate, it could delay some things. But most veterans are told that they need to be able to move ahead with their certificate right away, so they can be eligible and have it in hand whenever they need it. Okay, yeah.
And that'll let us know too whether they're required to pay a funding fee on the VA side or not. on that certificate of eligibility.
Oh, sure.
That's how us as lenders can see that and know how it needs to move forward. If that makes sense. So how I can help? Almost 5 years of experience training, reviewing credit reports. I've taken some specific courses. Obviously you can see I have a little bit of a passion for it. I really like helping people with that kind of thing. No cost, no obligation advice. Hey, I got a customer, they're doing this. We're thinking about buying a house in 6-8 months. They're talking about pulling a new credit card. They're talking about buying a new auto loan. What's your thoughts? Happy to have those conversations. Even somebody that's, hey, my scores aren't where they need to be and it's been a challenge. Well, let's take a look at it and let's put a plan together. If not now, how do we get there? And how do we get those scores to where you want to be to get you, one, into the home, and two, at a good price and, good rates and terms. So if anybody needs help with those things, happy to chat with them. Like I said, no cost, no obligations. But at the end of the day, better credit scores, better programs, better options, lower rates, cheaper for your borrower. Available tools. So what are some of the kind of the cool things we have? I do have what's called the what if simulator. So we pull the credit report, things aren't exactly where they want to be. Say those credit cards are a little bit too high of balances. I can do basically what's called a what if simulator. We go in there, we say, okay, we're gonna pay the credit cards down to $1,000, $500, this one, that one. These are the most maxed out ones. What's this gonna do for our score? It'll tell me I probably have a 90 to a 95% chance of taking that score from a 705 to a 740 to 750 range. Present it to the borrower, print out all those instructions. You need to take the Capital One ending in 3986 down to $500. This one, they send it in, make the payment. We get an updated statement right away from those creditors. We send that right into the credit bureaus. We do what's called a rapid rescore. We rescore the report. We pay for those fees. Can generally get it done in 4 to 7 business days. Now we have a new score, a new report, everything's ready to go in about a week's time. So if we do have some funds and the scores aren't exactly where they need to be, generally we can help them out in that sense. Rapid rescore, like I said, we just kind of talked about, client makes the corrections to the accounts or pays down the balances, we send in all the information, get a new updated report ASAP. Also, if things are really a challenge, we do have some, credit experts that can really help if need be on those kinds of things. Normal correction time frame for paying down accounts on your own side, probably 60 to 90 days till it starts to update. Like I said, if we were to do a rapid rescore or something like that, we need it ASAP, 4 to 7 business days. Any questions?
I have a question. Sometimes you have buyers that are shopping around. Is it normal, like when let's say they go to you and get the credit score pulled and they go to the next person, is that dropping their credit score every time they're going to a new lender, or how does that work?
Not every time.
Okay.
I would say you're probably, correct me if I'm wrong here, I would say probably that 2 to 3 range on the mortgage side isn't really gonna affect anything. You start getting over 3 mortgage pulls in a short period of time, we might see some drops.
Yeah, is there a standard there? I feel like I've heard timeframes, I've heard 2 weeks, I've heard 30 days, that they'll get lumped together as one poll. If you do end up going forward and securing a loan,
Yeah.
purchasing a house, then in retrospect, it kind of lumps as one. Does that make sense at all? Is
It
none of
does.
that true?
Yeah.
It does, but I think, and I've heard that same thing too, but I've also seen the other opposite ends of it where, okay, I think down the road, after a few months, they review it and look at it and say, okay, we're gonna put that in as one thing. It's not gonna affect your
You were
score too
clearly
far
just
down the road.
doing these activities for one purpose, so we
Right.
lump those activities together.
Yeah, but when you're kind of in the heat of it, that
So
score
it
is
hit you
gonna go down.
initially and then.
But it'll bounce back like it was all kind of one pull after it gets regrouped from what I've seen, if that makes sense.
But there's not like an official, if it's within 30 days or
It's
there's
gotta
not.
be
like-
under 30 days.
Under
It should
30,
be
okay.
30 days. And where we see the problem is they go car shopping. So they did a poll with two car dealers in January and they didn't buy anything. Then he went in February and pulled another 1 or 2. And then they did one in March. Oh my gosh, the score went probably down 80 to 100 points.
Yeah.
And the end in that 3rd month, they did open a car loan. So then you've got you've got 3 months where they pulled credit how many times and they took out a new auto loan.
Sure.
So
Yep.
then you can have, then it's gonna be a while for them to recover from something like that.
And I will say too, if your buyers, are looking to go auto shopping, be very careful. Something that happened to me, they're like, hey, we will apply for this, we could do the credit in-house. It's like, okay, I'm happy to take a look at it. This is kind of where I'm at. If you guys can meet these terms, we'll make it happen. They sent my report to 16 different lenders in a matter of 15 minutes.
So you got hit with
16
16
different
polls.
credit polls in the same day. I signed off on one poll. They shipped it everywhere.
Wow.
That's
You
why
say
you
I
get credit.
walked out of that
union
place.
with it.
And then the interest rates and terms, they told me, I have a loan calculator right on my phone. Was nowhere close to what the numbers come up to. Oh, we must have made an error. We must have made an error.
Yeah,
I want to check on that one again.
okay.
Can you explain the phenomenon of people paying off something? And your credit score going down? Like what? Why would that happen? I have, or not me, but you have a $2,500 left on a student loan. You go and pay it off. And then, you're not making the regular payment that you had to make. So now it's paid off and your score goes down. Like,
Yeah.
what is that?
I don't have an exact explanation for you. The only thing that I understand is they don't like it because the history of that account and your payments is going away. You have one less account with history moving forward, but I totally understand where you come from. Hey, I'm paying this off. I'm shooting for debt free.
I've
What do you
had-
mean
I've
this is
had
gonna
kids
hurt my
who-
credit score?
Whose parents give them money to pay off these things so they can go get a house, so that their credit scores actually go down.
Yeah.
So that's one of the things
It is.
when I counsel buyers, is don't pay anything off. Don't take out anything new and don't pay anything
Or
off.
at least wait till your lender looks at it and gets some
The
time
day
to
after
review
closing.
with you, yeah. But it is, like you said,
Yeah.
it's a little bit of big business that there's some weird parts to it. But being an educated consumer, knowing how it works, that's our best chance of
Yeah.
combating this and moving forward.
Is there an extra fee for rapid rescore?
No, we pay for that. So we cannot charge that fee to the consumer, we will eat that at the bank.
And I could say I've worked with CIBM in Sheboygan for 4 years.
Oh,
and I love
Thank you,
the interest,
Trish.
Yeah.
Yeah,
Interest.
love them. And I've seen this happen where counseling buyers and they went from can't get in a house to buying. And it's phenomenal.
I like the teachers part of that, I think that a lot of people, it's a big scary world to buy a house. But if you could just bite it off in chunks, and this credit part is always a mystery. Even for those of us who have been doing it a while or working, well, I don't understand why you can't pay something off, just don't. I don't know why you can't, just don't,
No,
until after we're done.
that counseling piece has been crucial for some of my clients.
Yep, and I mean, it's a little bit different if you're, got 30 years of credit history and you pay something off. It's
Sure.
not gonna hurt you as much as being a 22-year-old that has 3 to 4 years. That's kind of a different story where it might get a little bit of a drop there, but
Yeah, these are
the
usually.
consumer with not a lot of history, it's gonna hurt them.
Yeah, and I had one that went to a credit union, was told she couldn't buy.
Oh, yeah,
And I sent her to Peggy and Trish and she got loaned.
yeah, we get that all the time. Hey, 2 other lenders told us that we can't buy, so they come in with their head hanging down thinking they're already destined
Yeah.
for a third no, and we look at it and say, there's a couple things we can do.
Yeah.
Maybe you're not ready in 30 days, but maybe we can get you ready in 60 or 90 days. But everyone can buy, it's just a matter of when they are financially and emotionally ready to do that. And a lot of them are emotionally ready, but not financially ready, and that's our job, is to get them in that position and make whatever adjustments we can to make that happen for them.
Yeah, so I've probably got 3 buyers in the last 4 years that didn't buy.
Yep.
And ended up in the house.
Exactly.
Do you do anything with grants, DPP funds?
USDA.
No, just, I mean, everything a bank can offer and a broker. We also do non-QM. Do quite a few bank statement loans for self-employed individuals that do not show income on their tax returns. So they got a good accountant. They're not showing that income on their tax return, but they're making a lot of money and they're doing things wisely. You're gonna pay about 1% more in interest, but that interest is also tax deductible at the end of the year versus paying income tax. But basically what it looks like is we just I have a couple of them right now, but I mean, 12 or 24 months, let's start with 12 months, send me all your business bank statements for the last 12 months for your business. Business needs to be in business for at least 5 years, not a fresh business. They will look at all the deposits coming into that account, they will take an expense factor against those deposits, depending on the nature of the business. And whatever that income is after that expense factor is taken out, usually around a 50% expense factor, that's their qualifying monthly income. No tax returns.
Way,
no-
way higher than what anything shows on their tax return.
Well, I'll tell you that, back to what you were saying about people who don't get approved. They're in real estate, there's agents who do this, who just like the low hanging fruit. And then they walk away from things that aren't just easy slam dunks. There's a lot of lenders who do that too. It's the low hanging fruit. So to know that you'll actually roll up your sleeves
Yeah,
and work for a client, for our clients, so that they feel like there's a team effort there, that's really huge, right?
And, you know, the other thing that's really cool about the bank statement loan too, it's like, hey, there might not be like, do we need an application? Do we need to, let's just have the conversation. I can get that income certified before we even take the application, we move it forward, we do any of that. Just, hey, this is what it's gonna look like. I need you to fill out a business narrative that's basically 12 questions about your business. How many people work there? What's the nature of it? You sign off on that, send me those statements. We can get a qualifying income up front. Know if it makes sense or not. If it's not enough to get us where it needs to be, or it doesn't work, we didn't have to go through all these other steps to get there.
Yeah, and that can be done in 48 hours.
Correct.
Okay.
Yeah.
It's pretty exciting.
Experience matters.
It
Well,
really,
and you know what, though, I think it goes beyond that. It's the heart that goes into it. And I think that that gets lost a lot in transactions. But when it's relationships matter, right?
Well,
So-
let me challenge you a little bit on that,
Yeah.
and I agree with you,
Yeah.
the heart matters. But the heart without backup,
Of
doing
course.
something, we are proud to be a part of your team. You asked some really, really good questions about, what about credit pull? What, I heard this, I heard that, somebody told me this, somebody told me that. You know, all of you can change your own oil in your car.
No.
But do you want to? Or when something goes right, he just gave you a lot of good information. How much of it you gonna remember? Now, here's an interesting situation. Peggy and Trish, we do the same thing. We network with them back and forth. We collaborate back and forth. We collaborate as a team. So who do you want your customer talking to? Someone that's gonna give them straight answers? Because they're gonna come back to you and they're gonna say, wow, look what you did for us. Let's take a look at their credit. Oh, my credit's fine. It's fine. Okay. What if I could tell you that if we looked at your credit, we could lower your interest rate? Let's get looking at this early on. Let's do a soft pull to get an understanding of where we're at. He showed you what the difference in payments are. We have people that do the same thing. They wait till the absolute last minute to write an offer. Okay, now you can pull my credit. Now you can do all this type of stuff. And it makes it harder for you guys in this process. Part of our job on the other side is to network. We want this to be a very, very positive experience for your customer. We want them coming back to you and say, wow, like you're talking about Peggy and Trish right now. You know who you're going to want to go to. If Peggy and Trish are on the approval, they're going to look at it. And let's say you're on the buyer side, you're saying really good. But if you're on the listing side, oh my God, they're the people that wrote that offer. They've been doing it for a while. Peggy's been doing it for 45 years. You don't have that by accident. And Justin is coming up through the ranks. We're going to be retiring before too much longer. And that's the stuff that we're looking at.
Retired, maybe.
So now you have, so now you have an open.
Self-employed, that's.
Okay, well, let's talk about something. Well, here's the funny part. You just got done asking some questions about VA loans. You got a guy that you're working with, it's a lender. How many VA loans have you done? We've done hundreds, and I mean hundreds of loans, hundreds of VA loans, hundreds of FHA loans in this process. When we look at this stuff, we know how to read a financial statement. So the first thing that happens is people come into the house and they said, we're self-employed. Who doesn't have their knees buckle at that point going, oh God, tell me that they're making money. Show me that they have something in this process in order to do this. We just had a customer buying a house in Slinger, $1.3 million house. Anybody want to guess what his income is? $92,000 a year. He's like, that doesn't work. Everything was great. We said, what's your credit score? Our credit score, I'm at 760 credit score. I own my own business. Last year we did $3.2 million. We showed profit, everything he told us. I said, okay, before we go much further, what did you bring to the bottom line? I brought $800,000 to the bottom line. I'm 100% owner of the company. Now we pull it back. He did have $800,000 in profit. And on December 16th, at the end of the year, he bought $790,000 worth of equipment. So we didn't have the profit that was back in the company. Everybody goes, oh shit. Now we have $92,000 in income, which is not going to support a purchase of $1.3 million. What do you do? Justin told you, we did the bank statement loan, which is also known as the country club loan. Because these are the people that don't show a lot of income. Why is that? They don't want to pay taxes on it. As a result of what you're going in the process. There's an interesting thought. So now the interesting thing is that you go to these people, they say, you're not paying 7%, you're now going to be paying 8%. The people that do this understand this because they pay their accountants $100,000 a year in this process. Guess what? Your choice. Pay a slightly higher interest rate or pay the taxes. Which one do you want to do? At the end of the day, it's what they call where the rubber hits the road. Our bank statement customers are ecstatic with that. Why would you gross your income up to 400,000, pay that in taxes, and then come back the other way? Case in point, how do we look good? How do we make you look good? How does all this stuff go together? Someone was saying before, very, very intelligent statement, PMI. Do you put 20% down? Do you put 5% down? Do you do these types of things? Right now, if based on Justin's thing, we have some customers that are paying $10 in PMI. And you look at that and say, what's the cost difference to putting your money into your house? Conversely, that makes a big difference. So when you impart that information to the customer, how do you look? You look really intelligent at that point. The other thing that we're doing with some of these people is anybody work with the yield spread on with their lender? Anybody understand what that is? Okay, okay, let me explain it. We have customers right now in the unfortunate times that we have where interest rates are high. I'm not going to sit here and speculate on what interest rates are going to do. They're like a roller coaster. 4 years ago, we're at the bottom and everybody kept asking, are they going to go lower or are they going to start to go up? That's where everybody was. Does anybody have any idea what the political climate is right now? What interest rates are going to do? Everybody's asking, when are rates coming down? When are rates coming down? They will be coming down at some point. How soon? We all think it should have been sooner than what it is. So as a result, in our yield spread, the bank is tied to only making a certain amount of money on a loan, unlike a broker. Okay, so as a result, if they pay, like in some cases, 1/8 or 1/4% higher, their payment might go up $50. Okay, that difference over a 10 or 12-month period can be $500. But the difference is if they buy the rate down, like some of these places are doing for $3,000, they have a very difficult time getting the return on that investment. And we show that to them. Now, I'm getting the look that I want to see right now. It's the deer in the headlight look. How much more information are you guys going to give to me that I'm going to try to process this? Let me tell you what the tools are. Somebody has credit challenges. You know what? I'm going to have you talk to my guy, Justin. And when they get to him and they want to talk about that, they want to talk about credit. Kind of like when you go to your doctor, I got cancer. Well, now you want to talk to your doctor and you really want to understand what goes on in this process. Well, how does my money work? We'll do spreadsheets. And we'll give them to you that show, you put this in, you get this, you put this in, you get this. And you know what? There is nobody that's the same. Everybody's a little bit different. If their credit is like this, their credit's like this. He told you it's an algorithm. I'm not going to tell you it's an algorithm, it's a game. You saw what Experian does, you saw what Equifax does, and TransUnion. They're all just a little bit different. You want to go to somebody like Justin, who's done this before. He looked at this, and a lot of our loan officers at our bank are the same way. We want to close loans. You want to sell houses. He took it personal. He didn't like his credit score being there. And when you get to somebody that can actually relate it to, they say, you know what, here's a guy who did it. And do you want experience or do you want somebody to say, yeah, I could do that, or you could do something like that. We really enjoy that part of what we do. And it makes you guys look good because experience wins. You're telling me about your sons and everything that's out there. You got a lot of experience. It doesn't take long to meeting with you before people start realizing this lady knows what she's talking about, but if she doesn't know, she knows where to go to get the information, because then it starts to back you up. in
But
the
Justin
process.
might be a backup for something that's happening right now.
Well,
Yeah.
But that's the other thing. The other thing we tell people is work with a realtor. You need to work with a realtor. Realtors are going to get you more money. Show me how that works. The other thing is we work together as a team. Some people look at it, they say, oh, all lenders are the same. Oh, 30-year fix is all the same. Well, you already saw that if the credit score can be adjusted slightly, they can save some more money on the process. Or cookie cutter lender, they don't want to get the loan done. It doesn't fit in their situations. We're still closing millions of dollars in loans every month. Okay? There's a lot of people that are out of the business. Why? They don't have any business. They knock on your door begging for more business. And then your question goes back to them. It's like, okay, I could use you. What are you gonna bring to the table? I'll close your loan. Well, I really want to look good, because if you look good now, they're gonna send their sister, they're gonna send their brother, they're gonna send their cousin. That was a whole lot easier to work with. Or you get the lender that says, we got all this information, and then they came back and they wanted 4 more pieces of information. Then another week later, they want more information in the process. It's like, oh dear God, this is just, can't you ask for this the first time? Justin and Beth, they write pre-approvals on the weekend. They don't like me telling you that. But if it has to be, because somebody came through the house and they said, we like it, but we'd like to write, but we'll be with my lender will write your approval this weekend. That's pretty cool stuff. That's stuff that we really enjoy. I talked about the scenarios, the what if calculator that's out there. It's no guessing. We know with some degree of certainty, what if we do this? What if we do this? Can we get that score? We already pulled your credit. We already paid the fees for this. So I think you asked the question earlier, it's like, what are the effects are going to be with this? So now you didn't know that 15% was there, or was it 30% or 70%? Oh, that's my business card. I just pay it off every month. That's okay, right? Well, if we have a little bit of time, how are you going to look at all of a sudden their score goes from a 725 every year to now it's a 760? Well, they're going to look at you and saying, somebody on your team really did a great job. And that's the type of thing we want, because any of those types of assertions are going to make you a stronger person.
The other thing we're hearing from our insurance agents is that credit score impacts their insurance rates too, dramatically. Dramatically. So if we can improve that score, it improves their rate, their MI, and their insurance on their house. And those are things that are constantly part of, they're looking at what can I afford? What's my budget gonna be? And all of these things, because of their score, keep adding up. And now the payment has gotten to the point where it's really not affordable for them. How do we get them so that we can reduce that? So it is affordable and they're comfortable with it. What I say they could afford and what they're comfortable with might be 2 different things. They need to come together with that. So if we can all overall reduce that payment, including your insurance, it's a win for everyone.
Is there a workaround on no credit?
No,
So-
yes, yes,
Okay.
yes and no. And we certainly don't like no credit.
No credit, but no current credits, right? Like,
Oh, that's still credit.
Yeah.
That's still credit to us.
Yeah.
And Justin can help you with that. We will do some things. We're a blended family. We know what it's like to help kids out in the process. And sometimes we'll bring mom or dad into the loan and we'll refinance them off of it in the process. We can help build the credit. Sometimes people just have questions. What if I do these types of things? You know, I'm not gonna profess to how to put a deal together. You guys are fantastic at it. You're coming to us to say, how do we make these deals come together in this experience level? That's the type of stuff that we're gonna do. You know what we really like more than anything else? Boring closings. Really boring closings that say,
And big
no,
commission.
no, what that?
and a commission check.
Well, we don't get the commission checks you guys do, we do okay. But we're looking at it and saying, but you earned them, okay? There's no question about it. Our job right now as a lender is to make the process easier to try to debug this type of stuff. You know, like I told you, the country club loan. How many people knew about a country club loan before you walked in here in this process? Well, some of these people won't even look at buying a house because they didn't think they could buy a house in this process. So sometimes you have to figure it out and say, well, what works, what doesn't work? Divorces. How do we make these things work? People now are separated. And if you do it right, you'll work with him, you'll work with her, you'll have another relationship, and you'll start to build these things all the way across the board. How do you get a listing? Now, one of the funny parts about it is people say, oh, yeah. This lender was here today and they said, sure, they're gonna send you referrals. You know how we get you referrals? By working with your customers and our customers to say, what's your name? Tracy. Tracy sent us a referral and they like Tracy a lot, but they really like Justin in this conversation. The guy here, they were talking deer hunting and all the other stuff they did. So they didn't call you on the phone when they were gonna buy the next house. They called Justin, but guess what Justin's gonna do? He's calling you back on the phone and said, hey, guess what? The Smiths are ready to buy. That's what we do. And all of a sudden it holds that cohesiveness back together. Conversely, it works the other way. You know, people say, well, who's your lender and what do they do and how do they make all this stuff happen? We get all money from the Federal Reserve, just like everybody else does. Brokers are slightly higher, and yes, the credit unions have dirt cheap prices on their stuff. They don't pay their people well. Conversely, they don't have a lot of the expertise. That's what we try to take a look at. they need to do these certain things. That's why I joke about, you can change your own oil and you can go to your own places to make this thing happen, but we can save them that money. Why would people work with a realtor? Because you're gonna get them more money for their house. You're gonna get them the right house. And how do we explain that? Beth actually has had her broker's license for 40 years to do nothing but to help people explain that you need to work with a realtor in order to do this stuff. They say, well, what do you know about real estate? You're this. Well, 40 years license as a broker, only to help you guys in that process. We're not competitors. We don't sell houses. Questions for us?
Actually, I have a question that's kind of off the credit topic, so I'm glad we kind of got
Yeah.
off that. So I was trying to explain to one of my buyers, because right now, which I'm sure everyone here knows, people are being over. And I was trying to explain to them why they should put an appraisal gap in there in order to stand out, because their lender's not gonna go up to that if it doesn't appraise out. So they need to bring that money to the table. And I kind of was in chatting with another agent about it, and they said, I never have them write appraisal gaps. Won't the lender just go up to that amount? I said, I'm pretty sure no. No lender is going to give you more than what the house is worth. And then I'm questioning myself. So I'm like, no, I always have them try to write an appraisal gap. You have to understand that you gotta come to the table with that if it doesn't appraise out. Am I wrong in that? Can you, or maybe better explain it? Maybe was bad at explaining it.
You're correct, and it really, when they're coming in with a smaller down payment, that's a different story. If they're rolling in, from second house at 50% equity, we just adjust the LTV a little bit. But in terms of, your first time home buyer, 5% down, I only have set funds. The bank will only finance on up to that appraised value. Anything over that is gonna come back to if they negotiate price, if there's the contingencies, or like you said, we are seeing a lot of appraisal gaps, 5 to 10,000 is generally what I'm seeing up and above. Then from there, okay, we have a little bit of room to reduce the LTV, so you don't have to bring in as much to closing, or do you want to bring that additional in? Does that kind of answer your question?
It's always appraisal or purchase price, whichever is less. So if you get a house and it happens to appraise out higher than what your offer is, they don't get that equity. They do after they own it for a period of time, but otherwise it's purchase price or appraised value, whichever is the lower of the two.
95%.
How long is it until appraisal value becomes more effective than purchase price, did you say?
Well, when if they come back and do another loan, or they look at doing a home equity or so, and it's usually 12 months, after they've owned it for 12 months. So if it does, and we've had some that they've appraised out higher, even in this market, than what the purchase price was. Say, hey, this is a great house, you got a great house, you got a great value on it, and here's another 10,000 that's basically equity in your pocket for future use.
That you'll be able to take advantage of in 12 months.
Yes, exactly.
Also, we use that to evaluate for getting rid of the private mortgage insurance too.
That was where I was kind
Yeah,
of going with that.
exactly.
So you could say in 12 months, this is kind of a boost on your opportunity to hit that equity tier.
Yep.
Yeah, so one of the things you do, what you're doing right now is, as the customer asks you a question, Chrissy, just like you're talking about. You don't have to say, well, let me call my lender. Just call on the phone and say, hey, now what happens like this, with this, and let's give you the backup in order to do it. Then you call your customer back and say, okay, here's what I see happening, and this is what we can do in that process. You bring us in when you want to bring us in. We're not going to be there to run the show for you. We work under you guys.
Do you have a recasting product? So somebody wants to buy a house, but they don't want to put a home sale contingency, so they pay the 5% down, get the other house, and then they have 6 months or a year to sell the other house. Take the proceeds and drop it on the principal of the new house, but you don't charge 2 closing fees.
We can have them pay it down, and we can take a look at that. If we know those are situations going into it early on, we'll look at how to structure them.
That's really
Yeah.
to not have to write a home sale contingency, you have to.
Right.
You have to get creative, and that's really the only
Creativity right now.
way I've been able to do it for 5 years, is
Yep.
that way.
Yep, totally correct. Creativity wins every single time with valid ways of doing things in the process. We've seen some of the people out there saying, oh, we'll pay all the property taxes. We've seen waive this, do this, get that understood. Put yourself in the buyer's shoes. Are you gonna feel comfortable with that in the process? I will say, there are a ton of times that you need to do it. I mean, you get somebody that's a doctor or somebody that has making a large amount of money, you can say, weigh the differences and explain them out to you. then you have to make that decision. That's why they need to work with a realtor to have that same experience that's out there. What are they gonna learn from this in the process? Are you gonna explain these things? And then think about what they would do. Would you want to be working with somebody that's knowledgeable? You take your car in for the oil change and think, it's funny, it's my first time doing it. We're gonna both learn this together. You know what, I'm gonna go somewhere. This is not the kind of place I want to be. And conversely, if they say, all right, I'm gonna do this, but I have this question, hang on, let me get that answer for you. Because sometimes how can we back that up? And like Justin's talking about with Credit Karma, how do we make these things happen? Or I got really, really bad credit, I could never do anything like this. Trust me, being in it 80 years, there's not a lot we haven't seen.
8 years.
And Tracy, I've got a better option for you, for the borrower who wants to do,
It's basically a bridge loan.
right, what we do with that is we take the money out of the house. That's it,
Yeah.
so do a home equity loan on their house, take the money out, put it down on the new house. Then they're not paying mortgage insurance on that new house. And when they pay it off, the money's gonna come out of the current house, pay off the first mortgage and the home equity, which is kind of like the bridge. And then they don't have to recast that loan. So, and based on what their equity is down on the new house, they're getting the best.
Did
rate.
you do HELOCs then?
Oh, yeah,
Okay.
oh, yeah. So they're getting the best situation on the new house because we've got the down payment money. The key there though is they need to get that going ahead of time.
Of course, because you can't list the house
Yeah.
until.
Yep,
That's not
yeah,
right.
we need the home equity loan in place, even if they don't use it right away, but get it in place if they know that they're out there looking. And that's an ideal situation. And depending on the amount, sometimes there's no cost for them to do that home equity loan. That's an ideal scenario for the two house situation. Yeah.
Yeah, generally under $1,000 or under $100,000, $99,999. They're looking at under $200 in fees.
For the home equity.
For a home equity.
So, and then, yeah, it's ready to go. If they use it, they use it. If they don't, it sits there. They're not paying interest on it. But yeah, in terms of home sale contingency, people coming to us for that reason. Because we can do the HELOC in-house, get it structured,
Yeah.
have everything together in one set, whereas your broker is gonna send you to the
Yeah.
credit union or the
Yeah.
local bank. I call my guy that does the HELOCs, send him all the information, tell him exactly what's going on, make sure it gets to closing. Once it's ready to go, we call you guys back. Hey, it's ready, it's teed up, you wanna write no home sale contingencies, we're ready to go.
Yeah, it's all under one roof.
Yep.
So we do all of those steps.
Gotcha.
The other product that it has been really hitting some negative is the WIDA loan. Where can you get a rate out there now at 6% with very little money down? Don't be afraid of the WIDA loan. So Justin has become a real good specialist in WIDA, and it's first-time home buyer. It is income driven, and credit scores do not as much impact their rate either on that loan.
What's the minimum?
First-time home buyer.
WIDA has a couple programs, so they have a conventional program, they have an FHA, those in terms of pricing. Not the
Not
greatest
as
right
good.
now, at or above what market is, plus they're gonna pay a little bit of a point for it. Where WIDA shines right now is they have a first-time home buyer program. That first-time home buyer program, I believe it's still the 3-year, haven't owned a house in 3 years. But they do pay a point for it, so they will pay 1% of the loan amount at closing. So if they borrow $250,000, they're gonna pay an additional $2,500 on top of their traditional closing costs, title work, appraisal, things like that, for that discount on that rate. But right now I can't say I looked at it yesterday, but they're closing one next week that's at 6 and an 8.
6 and an
They've
8.
been right between 6 and an 8 to 6 point. When we had a little bit of the jumps a few weeks ago, they went up to 6.375, but generally they're about 1% less. If I take that loan and I price that out on a conventional, on my computer, conventional, you're gonna pay 3 to 4 points for that discount in a rate.
So you're paying his points, so at closing.
Yeah,
Yeah.
so 1 point at closing, like I said, if you're comparing that to conventional, I put them up side by side, price out conventional, what's it cost me to get down to 6 and an 8?
And there's
3.5
income
to 4
restrictions,
points.
is there geographical restrictions?
So anywhere in
No
Wisconsin,
Just income.
anywhere in Wisconsin is eligible. They do have certain what we call target areas where the income's a little bit higher than can allow. I have one going on right now. I think Clark County's all target area. But
Okay,
anywhere in
correct.
Wisconsin,
Mean income in the area, whatever that term is.
correct.
Yep.
Correct. So it's based off the average median income, which they will refer to as AMI.
That's it.
So it's a lot, but just let me try and break it down for you. So they look at it two ways. One is your qualifying income. That's just your qualifying income for the loan. You can afford the loan. What we can use, we don't have the history of commissions. We can't use that. So we only have to use the base. That's your qualifying income. They also have what's called compliance income. Everything for WIDA is deemed under compliance income. So it'll say, Washington County, Washington County and Wisconsin. Don't quote me. I want to say it's in the low 90,000 range for a household of 1 to 2 individuals. So that means all the income coming into that household has to be under that compliance limit of 90-some thousand. Also, we're a single individual. They're considered a household. So a lot of the first-time home buyers I have right now, single male or female out of college, they're doing VITA loans. So I can get them at 6 and an 8. The other one I just did. So their qualifying income is 80% of the average monthly income of the county. And if they're below that 80% of the average median income of the county, they also get discounted private mortgage insurance.